Hello and welcome. In this lecture video, I'm going to be talking about known liabilities, and specifically I'll be talking about accounts payable, sales tax payable, and unearned revenue, and also doing some associated quick check problems with each one of those topics, okay? So when we talk about known liabilities, those are liabilities that arise from situations with very little uncertainty. So little uncertainty with regard to what we talked about in the first lecture video, whom to pay, when to pay, and how much to pay. They can be set by agreements and contracts, and they're often very measurable. Okay? So examples again, as I was saying just a second ago, accounts payable, short-term notes payable, payroll liabilities, sales taxes payable, unearned revenues, and also leases. So as I said in this lecture video, we'll be talking about accounts payable, note and sales tax payable, and unearned revenues. Okay? So we know what accounts payable is, and so I'm not going to go into too much detail there because we know that if we were to purchase supplies or merchandise inventory on credit or on account, what we would do, right, is we would debit supplies or merchandise inventory, and then we would credit accounts payable, okay? So again, accounts payable amounts owed to suppliers for products or services that are purchased on account or purchased on credit, such as purchasing supplies or purchasing merchandise inventory, for example, okay? So now let's talk about sales tax payable, okay? Sales taxes payable. So most states and cities levy taxes on retail sales. Not all of them, but most of them, okay? Virginia, we do. And so sales taxes are a percentage of our sales price. And so what happens, this is pretty interesting with a company with regard to sales taxes, is that if you go to Home Depot, for example, and you purchase something and you purchase it, right, you have to pay sales tax. Okay? You have to pay sales tax. Well, that sales tax that you pay, Home Depot holds onto it and then remits it to the appropriate government agency at some later date. So basically, the company is serving as a tax collector. That's the company's role with regard to sales taxes, okay? So that's what we're saying over here. The seller is going to collect sales taxes from the customers when the sales occur, and then remit those collections to the appropriate government agency, okay? Sellers are basically serving just to collect the taxes. They're just a tax collector. That's all they are, okay? So if we look at this example, on August 31st, Home Depot sold materials for $6,000 cash, subject to a 5% sales tax. And I'm going to do the journal entry down here to record this. So I'll come over here and I'll say, all right, I'll take my $6,000 sales. Remember, this is the sales price. Now, just like when you purchase something, right, that's not the final price that you have to pay the cashier. Right? How much do you have to pay the cashier? Plus the sales tax, plus your taxes. So in this case, I'm going to multiply it times 1.05 to increase it by 5%, okay? Which gives me $6,300. So that's how much you give the cashier. You're at Home Depot, you've bought a lot of materials, you're going to do a big home renovation. $6,000, you bought all kinds of lumber and screws and whatever else you needed to do your home renovation. And the total came out, when you priced it out, price of everything was $6,000, but that's not how much you have to pay, right? You have to also pay sales tax. So you're paying $6,300. The sales price plus the sales tax. Okay. So what does Home Depot do? Home Depot debits cash for $6,300, which is the amount of the sale, right? The price of everything that you bought plus the sales tax. Now, they credit sales, though, for our $6,000, which is the price of everything that you bought. And then what do? They credit sales taxes payable for the 5% or $300 of that $6,000 worth of merchandise that you bought. Okay? So then, of course, when Home Depot has to remit the sales taxes. Remember, Home Depot is basically serving as a tax collector for the government agency. That's what's going on. So what happens is Home Depot at some point is going to have to send these sales taxes to the appropriate government agency. And when they do that, they debit sales taxes payable and then they credit cash. Okay, so when they send it to the appropriate government agency, right, they'll debit the payable and then they credit cash. The important thing to remember is that sales tax is not an expense for a company. It's simply a short-term liability, right? Because the seller, company in this situation, Home Depot, is basically just collecting the sales tax on the part of the government agency. And then they remit that to the appropriate government agency at some point in the future. And when they do that, they debit sales taxes payable and then they credit cash. Okay? So it's not an expense for a company. It's a short-term liability. All right? So what I want you to do is to pause the lecture video and do these two quick check problems here on page 251 and then come back and check it. Okay? Thanks. All right, hello and welcome back. So with our first quick check problem, number 54, sales taxes payable, is C, a current liability for retailers? Okay. And then when we look at number 15, Harville Company is required by law to collect and remit sales taxes to the state. If our company has $8,000 of cash sales that are subject to an 8% sales tax, what's the journal entry to record the cash sales? Well, the amount that I have to debit cash for is equal to the sales plus the sales tax. So 8,000 times 1.08, debit cash 8,640, credit sales for $8,000, and then credit sales tax payable for the difference, which is the 8% of the $8,000 at $640. So D is the right answer here. Okay? All right, so let's take a look at unearned revenue. So we talked about unearned revenue in lecture videos back in chapter 3, okay? And so remember what unearned revenue is when we get paid in advance. If we're a company, for example, a law firm, and we get paid for 2 years worth of legal services. So what this means is that over the next 2 years, we have to provide our client legal services because they're paying us up front. So we get paid up front and then we owe them legal services in the future. Okay, so that's an example of unearned revenue. Other examples of unearned revenue: advanced ticket sales for sporting events, airline ticket sales, magazine subscriptions, okay, construction projects, hotel reservations, custom orders, and also gift cards. Okay, so when we look at this example, let's look at this example regarding Beyonce and music concerts. Okay, so we were saying that advanced ticket sales for music concerts, that's unearned revenue. Beyonce gets paid up front, right? And then she can't recognize the revenue until she puts on the concert. She can't recognize the revenue until she puts on the concert. Until she puts on the concert, she has a liability to provide that concert service. So there's unearned revenue, all right? So let's look at the journal entry when she gets paid, right? So when she makes those advanced ticket sales, when she gets paid, she sells $5 million in advance in tickets for 8 concerts to be given in the future. So we debit cash. Okay. And then we credit unearned ticket revenue. Okay. So debit cash, $5 million, credit unearned ticket revenue. Now, let's say that on October 31st, Halloween, she puts on a concert. Now, just to keep things simple, let's say that each concert has the same amount of ticket sales. All right. That may not be the case, but just to keep things simple, just for explaining the concept, we're going to say that there's 8 concerts, total of $5 million in ticket sales for all 8 concerts, which means each concert has ticket revenue of $625. Okay, so after she puts on the concert, she can recognize the revenue, and that reduces her liability because she's put on one concert. So now what she would do is on 1031, she would debit unearned ticket revenue for $625,000, and then she would then credit ticket revenue $625,000. Okay, that'd be the journal entry. So once she puts on the concert, she has earned the revenue, and per the revenue recognition principle, that's when she can book this revenue right over here. That's when she can recognize the revenue, when she earns it. And how does she earn it? By putting on the concert. Until then, she has a liability. Okay. All right. So that's unearned revenue. And so what I want you to do is to go on to the next page and do these quick check problems at the top of page 253 of your course pack. Do these quick check problems, pause the lecture video, and then check your work. Okay. Thanks. Okay, hello and welcome back. So let's see how you did. So on number 55, unearned revenues. They're also called deferred revenues. They are amounts received in advance for customers for future delivery, also called collection advance, also called prepayments. E, all of these is the correct answer. Okay. Number 56, advanced ticket sales totaling $6 million cash would be recognized as follows. This is when we get paid for our advanced ticket sales, right? So it'd be debit to cash $6 million and then credit unearned revenue or unearned ticket revenue for $6 million. So C is the right answer for number 56. Okay. Okay, so I'm going to stop this lecture video now, and then the next lecture video will cover short-term notes payable. Thanks so much.